Welcome to the BDO Tax Support for Professionals webinar program. My name is Chris Holmes, and today I will be your guide through the key legislation, tax planning, pitfalls and practicalities of distressed debt. This presentation was recorded on the 20th of May 2020 and is based on the law and practice as at that date. If you have any queries or observations on the material contained in this webinar, do not hesitate to email or telephone me or any of my colleagues whose contact details are on the final page of this slide pack. Before we dive into the material, a brief word about BDO Tax Support for Professionals. We're providing proactive tax advice to accountants, lawyers and in-house tax teams for over 30 years. We're all professional tax advisors and know that sometimes you just want to clarify or confirm your thinking, or even perhaps need to reach out for help. This is when the TaxLine telephone helpline is there for you. For larger projects, we're able to help you scope out the work required and to assist as much or as little as you require, including providing formal written advice. We're able to provide an upfront free quote so that there are no surprises. If you would like to find out more, do visit our website at bdo.co.uk/TSP, where you can also sign up to our free weekly newspaper. Alternatively, just call 0845 356 0006. We are here to help. And now, without further ado, let's get on to the webinar. Let me start by explaining the difference between writing off a debt and releasing it. When a caller to the tax line starts asking about writing off loans, it is usually an indication that they have their accounting head on and not thought about the legal process necessary. In a nutshell, writing off loans is an accounting concept which does not affect the enforceability of the debt. Simply telling the borrower they need not pay you does nothing, as you can later change your mind and seek collection. Something must be done in law to release the borrower from their obligation to pay the debt. This could be the lender executing a deed of release, or the lender and borrower entering into a contractual settlement. As noted on the slide, we have seen companies temporarily reinstated after being struck off so that a related party debt asset can be released. Now that we are moving on to the tax, I would first like to reiterate that corporation tax has its own special loan relationships regime. So at the start, as I'm talking about capital gains tax, I'm looking at the position for individuals and other persons not within corporation tax. I will talk about companies and corporation tax later in the presentation. The starting position is to say that a simple debt between two persons is exempt for CGT purposes. So, unless the relief is otherwise available through specific provisions, no relief is available if a simple debt becomes irrecoverable. That said, second-hand debt is within CGT, for which the normal rules apply. It's important to note that CGT base cost is likely to be the market value of the loan when first acquired and not the principal amount. I think most of you will already appreciate that loan notes and debts and securities are also within CGT, that is with the exception of qualifying corporate bonds. Foreign currency can be a particular awkward matter to consider. Strictly, the spending of foreign currency is a disposal of the currency asset and a forex gain or loss will arise. However, there is a specific exemption where the spending is personal expenditure. Hence, holiday spending money will be exempt. However, clients may hold foreign currency for many other reasons for which forex gains may need to be considered. I still recall many years ago trawling through foreign currency bank accounts, calculating the forex position. It was a long and laborious process. Since then, the foreign currency bank account provisions have been introduced, meaning that such accounts are considered simple debts and therefore exempt. However, the exemption is not as widespread as it first appears. For example, the account must be in the individual's name, so will not apply to nominee arrangements. It also needs to be an account with a bank, and not all deposit takers are considered banks. Although simple debts are exempt to CGT, when a qualifying loan made to a trader becomes irrecoverable, specific rules allow capital loss to be claimed. The key points are that the borrower must use the monies lent in its trade, or in the case of a group company in the trade of another group member, and that the loan has actually become irrecoverable. Looking at this second point, the three cases highlighted here demonstrate where HMRC may contend that a loan has not become irrecoverable. Firstly, whilst the trader continues to trade, HMRC will not usually accept the loan is irrecoverable because there remains a chance, even if very slim, that the trade will recover sufficiently to repay the debt. Secondly, there's a case where a person continues to lend monies to a failing trader in order to keep them afloat. Here, HMRC would argue there was little prospect of ever being repaid when the loans were made. Therefore, the subsequent loans have not become irrecoverable. They were effectively irrecoverable when they were made, and therefore no relief will be allowed by HMRC. Finally, there is the position where the lender formally releases the debt. Again, HMRC would seek to deny relief on the basis the debt was not irrecoverable except by the lender's own actions. Consequently, for the relief to apply on the release of debt, it normally requires some kind of insolvency procedure, such as an offer made by the borrower through an IVA or CVA. Now we look at corporation tax and the loan relationship provisions. The general rule is that tax follows GAAP accounting. What this means in practice is that the lender will receive relief to the extent that it provides against the debt asset or recognise a release in its accounts. But in contrast, the borrower is usually expected to include its debt obligation in full on its balance sheet, so only recognises an adjustment if the loan is formally released. An income credit will then be recognised in the borrower's profit and loss account, which will generally be taxable on the company. However, there are a number of cases where such an income credit for the borrower need not be taken into account. These include debt equity swaps and formal insolvency arrangements, including CVAs. The corporate rescue exemption is relatively new legislation which applies where it is reasonable to assume that without the release there would be a material risk that the company is unable to pay its debts over the next 12 months. HMRC state that they consider that this only applies where there is a real prospect of insolvency without the release. On the tax line, we are occasionally asked about shareholder or other related loans in this context. The problem with such loans is that they're usually open-ended, so leaving them in sight is unlikely to affect the company's ability to pay its other debts. Turning to connected companies, there are a number of provisions that may need to be considered in respect of intercompany debt. The resulting tax analysis can therefore be quite complex, especially when it involves cross-border lending, and specialist advice may be required. Under loan relationships, special rules exist which ignore debits and credits in respect of an impairment of debt, both for the lender and borrower. Connection has its own definition here, being that one company controls the other, or both companies are under the control of the same person. Person is recognised as including persons acting together. We receive many calls to the tax line about whether two companies may be connected. Sometimes they prefer there to be a connection, and other times that they're not. Points to consider include that there is a distinction between acting together and acting with common purpose. Spouses should not be assumed as always acting together. And all parties must be shareholders of both companies, otherwise they do not act together to control both companies. To demonstrate shareholders acting together in respect of a specific company, it may be possible to have them enter into an agreement that they will always vote together in their capacity as shareholders. It is important to note that the tax residence of other connected companies is irrelevant. So if a loan to an overseas subsidiary is released, the lender will obtain no relief despite the borrower being outside the scope of corporation tax. If we quickly look at unallowable purpose, this could actually apply to unconnected companies as well, but is usually seen where there are common shareholders. In effect, a lender will be denied relief for the impairment or release of a loan where the making of that loan was not amongst the business or other commercial purposes of the company. HMRC manuals include an example of a loan to a football club supported by the shareholder director. We more often see interest-free loans being made to another company owned by the same shareholders. The purpose of such loans is usually to help the shareholders, and there may be little or no commercial benefit for the lending company. However, if such related company loans are made on commercial terms, the relief should not be denied under the unallowable purpose provisions. Looking again at loan relationships, special provisions apply when a loan previously between unconnected parties becomes connected. This can happen in two ways. Either the debt asset is brought into the group of connected companies, or the lending company is. If the debt is acquired by a connected company, it is usually at a discount. The original, unconnected lender will be able to claim relief for its loss on disposal. There is a deemed release for the borrower of that discounted amount, effectively taxing the borrower on the same amount as the original lender obtains relief. Similarly, if a previously unconnected lender has recognised an impairment, they will have claimed relief thereon. On becoming connected, the borrower must recognise a deemed release, essentially taxing them on the same amount for which the lender has obtained historic relief. It is, however, important to note that the corporate rescue exemption, which I have previously discussed, may apply in respect to these credits. It is also important to consider the shareholder's position when releasing loans between non-group companies. When such a loan is released, there is in law a distribution to the shareholders equal to the market value of the loan at that time, and this will be taxable on the shareholders. There may also be employment-related securities charged to directors of either company to the extent that value passes into shares they hold in the borrowing company. Consequently, the first question I always ask when such calls come into the tax line is whether the loan is irrecoverable. It should also be noted that from a Companies Act position, the company may need sufficient reserves available before it can write off a loan. Let us now look at loans to participators. Looking first at corporate lenders' position, a Section 455 charge will arise when a closed company advances monies to a participator and the loan remains outstanding 9 months after the year end. The charge may also apply in other circumstances where, for example, a participator may benefit from a loan made to a third party. Many think of a participator as a shareholder or someone associated with them, but the definition is actually wider, including other persons such as some loan creditors. A 455 charge is 32.5% of the loan outstanding, which is paid as part of the company's corporation tax liability. Essentially, it is a payment on account that is repayable once the loan is repaid or released. The refund is, however, not made until 9 months after the accounting period of repayment or release. It is first set against the company's corporation tax liability payable at that time, with any surplus then returned to the company. Looking now at the participator's position, if they are a director or employee, the loan will be subject to the normal benefit in kind rules for interest whilst outstanding. If the loan is released, this will be treated as a distribution to the participator, whether or not they are a shareholder, director, or employee. However, it should be noted that, although the normal employee loan rules are overridden for income tax rules, on a release, Class 1 NRC remains payable. Up until this point, I've only really considered the position as it relates to the loan principal. So here, on this final slide, I'm discussing what happens if an obligation to pay interest is also released. The overriding position is that relief is only available if the interest has already been taxed. As individuals pay no tax until interest is paid, it becoming irrecoverable merely means tax will never be paid thereon. In contrast, companies usually, but not always, recognise interest and pay tax on the accruals basis, so relief should be available if the interest becomes irrecoverable. It is, however, important to confirm that corporation tax was actually paid on the accrual, as there are circumstances when it would not have been. For example, on a shareholder loan, where interest was accrued but not paid within 12 months of the year end. In such situations, no relief would be available. As noted on the slide, where a part payment is received at the time of release, it is necessary to identify to what extent the payment related to interest or loan principal. You need to know the amount of interest income paid, and conversely, the level of relief available on the release of the loan principal. Thank you for watching this presentation. Should you have any questions, please call the helpline or call or email myself with the contact details as provided here. Alternatively, feel free to contact any of the TSB contacts listed here. Thank you.